vital statistics what I call the vital statistics on the National Stock Exchange, and some of the facts that we discussed earlier in the week were new to me. I wasn't even aware of some of the stuff that you mentioned. So let's kick it off with that.
All right, Gautam. Thank you so much. Always a pleasure. It's been a while since I was on your fireside chat, and it's great to be back. I do have a presentation. I could go quickly. This is a seasoned gathering, so be happy to go through the presentation. I could always pause wherever discussion is needed, and otherwise, I just wanted to start off with saying that yes, National Stock Exchange is one of the world's largest exchanges in every way, any manner. Broadly in terms of market cap, India is India comes after the US, China, and Japan, so it's the fourth largest market in the world today, and bigger than the UK, bigger than France, Germany, many others, and in terms of activity. NSE is one of the world's highest traded exchanges in the cash segment, and it is by far the highest traded exchange in derivatives. For the last 5 years, NSE has had this pole position. On any given day, in terms of financial transactions, NSE does about 45% of global transactions, 45%, and about 60% of all derivative transactions. And if you look at only equity derivatives, then the numbers are even higher. So that's the kind of market share NSE has got. The number of orders that NSE gets on a regular basis are also very significant. So for instance, UPI does about 12 billion transactions in an entire month. So the NSE gets about 16 billion orders on any given day. So the kind of numbers that happen at exchanges, and NSE is not alone. There are other exchanges worldwide that are in NSE's class. So the Shanghai and the Shenzhen exchanges, Chinese exchanges, are both very, very active as well. But NSE in the last 3 years has been even higher than any of them. So I would now, with your permission, Gautam, go to the presentation, if that's all right. And we could have questions on them. I'll just share my screen. You have to enable screen sharing, please. Yeah. So is the screen visible? All right. So I'm going to talk about retail investor participation in India. Parts of the presentation I can go very quickly for this audience, but I will spend some time on some of the numbers. So yeah, this is the kind of flow. I'm going to talk very little about market performance. I'm going to talk about flows and then how retail investor growth and activity have picked up in India, and also some kind of geographical distribution. So this is a very familiar return quilt for investors, basically many asset classes, and their annual returns for the last 10 odd years. What's interesting here are some of the circles that I have put up. In 2022, thanks to central banks raising interest rates, it was a negative year for most of the world markets, and that's when it was the second year of the pandemic in India, and you notice that thanks to the central bank raising rates, most of the global equity indices were in the red, but not Nifty. Nifty was actually up roughly 6%, when MSCI emerging markets were down about 19%, or nearly bear territory. Nasdaq was in bear territory. The following year, again, Nifty went up 21%. This year, Nifty is up about 3%. So what exactly is happening is something we'll delve in greater detail. Nifty over the last 10 odd years has given this kind of performance. So when you compare with the MSCI emerging markets, 100 rupees would have given you 106 today. Not much happening there. US has been okay. S&P 500 would have doubled your money, but Nifty would have tripled your money. So 350 on the Nifty here. And what's essentially happening this year? Generally, this is 2023. So performance was largely led by financials. This is something, again, the waterfall is very clear for everyone. This is flow. So what we have done here is taken public data, and this data is available for everyone. And I say public because I'm going to talk a little bit about data which is not in the public domain later on in the deck. So today I'm talking about, at this point, I'm talking about FII and flows in the equity and debt channels. So the lines here basically tell you that generally FIIs have been buyers, and in debt also. There have been some years where they have been sellers. FY22 was one such year. And if you look at it from an annual perspective, so this is the data for the last 24 odd years. You will notice that FIIs are barely sellers for a year. In FY9, this was the GFC, global financial crisis, was when FIIs sold about $11 billion. And of course, pandemic was the biggest sell. The second year of pandemic, FY22 was big. But this, as we know from our previous slides, was not really the pandemic. It was the central banks raising rates. And they were negative the next year as well. But this year they have come back, and they have come back big. So $21.8 billion already. Now, that has led to FII share in the market staying about flat. So, overall, FII numbers are about 40% of the free float. This is where FIIs are at the moment. And this is DII flow. So DIIs for us are mutual funds, insurance, and so forth. And you will notice that barring 1 year, FY17, they're all in the positive. The flow numbers have been positive in 7 out of the last 8 years. And again, the same chart for DIIs. Now, this is something interesting here. Look at the last 3 years. This is when even DIIs have started putting in a significant amount of money into Indian equities. So if you look at it in terms of billions of dollars, $30 billion in FY22, $32 billion the following year, and this year, while FIIs have put in about $21 billion, DIIs are not far behind. They have put in another $18 billion as well. So very, very significant inflows by DIIs as well into Indian markets. Now, what's happening here? DIIs are getting money from investors, Indian households. So the broad theme here is basically Indian households allocating capital into non-fixed income based assets. So a larger share, a larger incremental share of Indian household savings are getting into the markets. And that is something to be, to ponder about. And yeah, now this was all public data. Everything here is public. This is not really public. So we are, we are India's largest exchange. We have about 93% market share in cash markets, and in derivatives, we have slightly above 99% market share. So if you look at the cash markets, this is the kind of money that retail investors have put into Indian markets. So barring the last 3 years, retail investors have been generally, very small in the markets. Look at the, everything except if you could see this. This is all barely around zero or negative. It's only in the last 3 years things have picked up. This is FY22. This is FY23. This is FY24. People have started putting money again. And this was FY21. So something has again changed here. And how do I show this on an annual basis? This. So how much money have people put in? By the way, this is rupees billion. This is not dollar billion. But if I add up this number in the last 4 years, retail investors have put in $46 billion into Indian markets. In rupee terms, that will translate to about 3.5 lakh crores or 3.5 trillion rupees. So what has it led to? Retail share in the market's floating stock has gone up from about 17% to nearly 20%. This is a 3 percentage point increase in a market which is $4.6 trillion in size. So this is the big jump in retail investments. So I showed you here the jump in indirect investments by households, this part, and this is the direct investment. So significant amount of capital has come into Indian markets from Indian investors as well. vis-a-vis foreign investors. Now, the next part of my deck would show you where exactly are these investors coming from. So India, I was talking to Gautam earlier, India should not be considered just one country, because there are several states in India which are themselves bigger than, many other countries that we are, familiar about. UP, for instance, has over 200 million people. There are not many countries in the world with that kind of population. The state we are in here has also, is bigger than many of the, in fact, most of the European countries. So significant numbers here. And this is how the flows are sort of happening. We break down India into, four parts. And traditionally, what's happening was that western part of India was always the lead. In Maharashtra, Gujarat is where investors were usually coming from. What has changed here is the advent of North India. So UP, for instance, is significant. Out of the 29 states in the country, only Maharashtra has over 1 crore investors. And when I say investors here, I do not mean people with demat accounts. I mean people who are uniquely positioned by PAN. So if I'm if I have 2 demat accounts, I won't be counted as 2 investors, but just one. So in terms of unique investors, Maharashtra has 1 crore, over 1.5 crores, in fact. UP is likely to become the second state that will cross 1 crore. They are at about 96 lakhs. 9.6 million is where UP is at this point. And this is significant. I mean, there's a huge jump in what has happened in North India. You can see this in this part of my deck. And this is really picked up over the last few months. Let me go to the bigger number. So the number of investors in India, unique investors, were about 27 million or 2.7 crores or 270 lakhs in 2018. And you can see that jump. So in March, we crossed 90 million investors. And how long did it take? It took about 5 months. That's about it. 5 months to add 10 million investors. And at the rate we are at today, we add about 75,000 to 100,000 investors every day. And these investors, I showed you geographical spread here. In terms of coverage, so we cover about a very big part of the country. So India has 29 states. India has 700 districts. India has 19,250 pin codes. And there is an investor today in all but 30 of them. Literally, all but 30 or 32 of them have at least one investor today. So we cover about 99.85% of all the pin codes in the country. And you can see on the right side how investors, I mean, these are not just, these are not static investors. They are very, very active investors as well. So you can see how the number of investors in the market. So what you see on the left is anybody who has ever traded or opened a trading account. These are people who are actually trading. That number is also a very big number. And it's gone up 7 times in the last 10 years for the cash market and 12 times for the derivatives market. And again, this is the monthly trend. I'm going to speak a little more about it in detail. All right. The third part of my deck is I'm going to talk about what is their share of turnover. It's not enough that you basically just come into the market and trade in the market. It's also important if you really trade. And the earlier part of my career at Religare or before that at Citi, FIIs were big clients for us. So FIIs today, in this in this slide, you can see they contribute to about 15% of the turnover. That's it. So you can see the last number there. So they contribute to about 15% of the daily turnover. And DIIs, which is mutual funds and insurance companies, they contribute about 11% of the daily turnover. And compare that with retail investors, they contribute to more than a third, 35%, 36% of the market on a regular basis is traded by retail investors. This is the sort of huge pie that we have today. And these numbers had jumped up to 45% in FY21. So what we have shown you here are the last 21 odd years. And so this has been a trend for a while. So retail investors have always been fairly big. But now look at this in terms of size. So this is adding up to 100, of course. But look at this. So This shows you the scale of how retail investors have picked up. So these were, in FY03, for instance, the overall turnover, annual turnover was about 12 trillion rupees. That 12 trillion has become 365 trillion today, 365 lakh crores. Compare that with India's GDP. India's GDP is about 300 lakh crores. So India's turnover is higher than India's market cap is, of course, higher than its GDP. India's turnover is also higher than its GDP in the cash market. I'm not even talking about the derivatives markets here. So this is how retail investors have certainly picked up, and part of it is also the prop world. Prop investors have really picked up also. This is the the machining or the algorithmic trading advent of Indian markets here. This is this part of the story. And same thing in derivatives markets. Derivative markets, retail investors are not kings. They're at about 25%. 40% here is by the prop traders, or as we know, principal traders. Now I'm going to just, towards the end, I'm going to show you some numbers here. So in February, about 1.5 crore people, 15 million people traded in the Indian markets. And you can see how that number has gone up since December. So December, in the second column, last row, about 1.26 crores, so 12 million people. That went up to 14 million in January, and it's already 15 million in February. So this is one number. So a significantly higher proportion of people are actually trading today on a monthly basis. That's one point. The other thing is we've broken down this turnover by categories. So 20 trillion was the turnover in December, which went up to 24 trillion in January. But remember, February is a smaller month, shorter month with less trading days, and still the turnover was almost the same, 24.9, 24.6 or so. But how is the skew in this market? Look at the last panel here. So for February, very interesting, 0.2%, 0.2%, 20 basis points of this 100%, 1.5 crore people, they contributed to 76% of the turnover. So that's how skewed the market is. If you add up the first three rows or so, 32, 33, 34, so about 67, 83, about 90% of all the people that traded in the market contributed to about 3% of the turnover. Yeah, that's my third last column here. So 90% of people contribute to 3%, 20 basis points of people contribute to about 75% of the overall turnover. So that's the kind of, it's just an illustration of the skew that we have in the markets today. And how is it in the derivatives market? Again, very interesting. So if you look at the last line here, the number of people that have traded went up from 4 million, 4.1 million, 41 lakhs in December to 46 lakhs, 4.6 million in January to 4.8 million in February. And again, the skew remains. So just about 30 basis points contributes to 75% of the turnover. And, here also 20, 44, 74, 75, 75% of people contribute to about 2% of the entire premium turnover. So very, very, skew. So the story that's coming out, I'm going to talk about it a little bit, summarizing it. I've already mentioned this. UP is one place which is, surely bringing in many more new investors. No other state. In fact, Maharashtra here is very interesting. The number of new investors is actually coming down here, but UP's share is going up. And, just for just background information, this is how our market has been changing over the last, 10 years. So FII is not so much, 21%, 22%, 18% today. Retail, again, 7.9%, 8.4%, now 9.7%. Retail share is rising. And because we are all very familiar with the mutual fund Sahi Hai, ad, 3.3% of the market in June 14, 7.8% in 19, and now 8.8%. So that's sort of rising. Again, something very interesting here. This is, when I look at this market, if you add up non-foreign, non-promoter space, so which will be retail, mutual funds, banks, that's larger than FII market share in India. So I've written that in the bullet. So free float ownership of these three groups, retail, mutual funds, and banks, is about 48% today. FII share is about 37%. So that's again something to know. What exactly are these investors buying? And I've already mentioned retail investor growth in the 3 pie charts here. And what exactly are they buying? So if you look at the NSE listed universe, retail investor share is about 10%. But if you look at the tail, so the way there are 2000 stocks in NSE. The first 100 are called large caps. Then you have 150 mid caps. And then you have another 250 small caps. And beyond that, there are 250 micro caps and everything else. So if you look at the, Nifty 500 and above, retail investors have 20% of that share. So again, the retail portfolio is much more diverse, not necessarily large bets there. And look at the FII share from 18% for the NSE listed universe. Nifty 50, they have 25% market share. And, if you look at the tail, they have just about 5%. That is also an opportunity in some sense. Yeah, this is the same thing for from a free float perspective. And I just wanted to say that portfolio allocation by individual investors is also rising. So, in March 20, for instance, at the pandemic, the top decile in the market, these are the large caps. Retailers had 80% of their portfolio in the top decile. That has diversified into 65% here. What's happening? Retailers are buying into these are the top 200 stocks, next 200 stocks, and so forth. Look at this. So what's happening is retailers are diversifying their portfolios. We do not see similar things. I mean, to a small extent for FIIs, this is 80% to 65%. This is 93 to 80, about 90%. So FII is not so much, retailers a lot. And, DIIs, of course, to some extent, from 87%, they've gone to 80%, but nothing like retail investors. So they have, they've widened their portfolios considerably in the last 3 years. So yeah, this is my summary. We've had a great run so far. I think 8 of the last 9 years have been positive. And markets are up 150% plus since the March lows. And institutional flows have been, FIIs, but now retail flows are much larger. So retail investor share has, gone up significantly. The amount of money that they have put in, retail investors, is 3.5 trillion directly. This is, about $46 billion. And they have been buying the tail end of the market. So yeah, I have a little more appendix here, but I'll stop sharing. Yeah. Happy for questions now. Sorry, that took long a little bit. Yeah.
No, Tirthankar, that was fantastic. I think phenomenal overview. And, we discussed earlier in the week about the rise of the Indian retail investor and the way that spread. I think one of the statistics that I saw in your report was that 99.85%, and that's very precise, the penetration in terms of PIN codes from the NSE's investor base has gone as detailed and as penetrated as 98.85%, which is a remarkable number.
99.85%.
89.85. Okay, I got that wrong. But
no, 99.85. Sorry.
99.85. Okay, I knew it was somewhere in the 90s. So very, very interesting. What do you think really is causing these investors to come into the equity markets, which they never did before? And this seems to be a COVID and also a follow-on of post-COVID phenomenon.
So there are 3 major sort of pushes. One is, people are looking at non-fixed income-based assets, as I mentioned earlier. Household savings are getting diversified. Indians generally would save in gold, physical savings, and to some extent financials. And financials would largely be, fixed deposits. But over the last few years, people have started looking at other asset classes as well. And, and this is where, going up the risk return trade-off, people have looked at equity-based products. So mutual funds and stock market, stocks come in handy. Where retail investors have seen lower and lower FD rates. So FD rates have come down, from 9% odd. Now they, of course, have gone up in the last 2 years, but they had a secular downtrend over the last several years. We had our, balance sheet problems, twin balance sheet crisis with the banking system. Interest rates were on the way down. So for the savers, interest rates risk-free were giving them lower and lower returns, whereas equity markets have, on the other hand, given very positive returns. So that's one thing. The second part is, of course, access to internet and cheap mobile telephony. So internet is getting better and better in India. It's one of the cheapest in the world. And mobile phones, thanks to India's enormous scale, are very affordable. Smartphones. So the vast majority of people today trade through mobile phones. So 20% of trading today in India happens on mobile phones. So that's the kind of number. And the third part is, of course, the DPI, the digital public infrastructure that's been put up by the government. So you have UPI for transactions, you have Aadhaar for identification, you have the entire India stack that allows you seamless identification for you to join any kind of a bank, mutual fund, or what have you. So all these things have sort of come together in India. And of course, the pandemic was that trigger which had many people sitting at home, and then it sort of picked up big time. What has happened, Gautam, is the incremental flows from retail investors may have petered out to some extent at least until August last year. They picked up now, but the number of new investors continues to keep rising.
I guess, that points me to a question which I've been asked increasingly by the media and also other fellow fund managers, is the fact that what exactly do you think is causing this banking liquidity crisis and the shortfall that you've seen over the past 6 to 8 months? Is it the fact that retail investors are not putting money into the banking system and are instead putting money in the equity markets? Is that part of the reason?
I may not subscribe to that view, Gautam. What's happening is it is sort of understood that if deposits are not going into, or rather savings are not going into fixed deposits, they are seeing alternate places to, as parking areas. In reality, what typically happens is, if my money is not going into an FD and it's instead hypothetically, going to a mutual fund, it is going to the bank deposit of that mutual fund. And when the mutual fund buys a particular stock, the money keeps in the banking system. So, the overall deposit growth for the banking space should not be affected. What may be that incremental deposits by retailers, by individuals, so households rather, should have seen that drop. So we typically break down, the economy into three parts. There's the government, there are the households, and the third part are corporates. And in the analogy that I've given, the overall banking deposits will not see any change, particularly due to reallocation. However, households allocation in FDs, will definitely see a sort of a drip. What is happening instead is credit growth is rising. The economy is on a recovery phase, but deposit growth has not really picked up. So large parts of the economy have not really done so well. So, which is why you are seeing this big stretch. Credit growth has gone to 20%. Deposit growth remains around 14-15%.
Sure. The one thing that took a lot of people by surprise is the 8.4% GDP print for the third quarter. And at the same time, you had a situation where consumption slowed down. There is a pretty high percentage of youth unemployment. So how do you reconcile this?
So I think Joan Robinson, Amartya Sen's guide, Joan Robinson, very famous economist, she once said, whatever is true about India, the opposite is also true. So what's happening is, the third quarter GDP print were a surprise, a significant surprise. Yeah. The GVA, not so much. So GVA is economic activity. GDP is spending. The gap between activity and spending comes due to net taxes. So these net taxes are what you basically get to spend is additional taxes and net of subsidies. So what had happened was the subsidy number was a little lower, and that's what led to the big jump in GDP, but not so much as GVA. Having said that, questions do remain on the gap. We believe that looking at quarterly data will not suffice. It's It makes much more sense to look at annual data. And notice one other thing here. Quarterly data is subject to revisions, significant revisions. You will finally see numbers of the third quarter, maybe 2 years from now. These are barely, first advanced estimates, second advanced estimates or so. And annual data in that sense will be far more stable. Even after accounting for that, India's recovery has been significant. So,
Sure.
If we do end up, at a 7% number for FY25, that will be the fourth consecutive year of 7% growth. And, I look at the IMF World Economic Outlook, and I don't see any other country even close to that number.
True. No, absolutely true. We also saw the manufacturing PMI at 59.1, apparently the strongest in 16 years, which is great. Wanted to get your views on that, and also the fact that the capacity utilization in the private sector, is starting to inch up north of 75%. Do you see private capex returning anytime soon?
So, the manufacturing PMI is 59 and services PMI 60 plus. So India is off the charts in terms of PMIs. When we compare PMIs everywhere else, Indians generally are a little more sanguine than pretty much any country in the world.
Yeah.
So, which is definitely a positive. Insofar as private capex is concerned, I have just a couple of views here. To have private capex pick up, you need very significant and sustained demand, aggregate demand from the private sector. Remember the analogy I kind of alluded to earlier. So there's the government, there are households, and then there are corporates.
Yeah.
You need to see significant household demand coming up. Overall consumptions numbers were just about 3%. That's where you've not seen it. So that's the first order condition. The second order condition is, do you have the capability and wherewithal to do it? In other words, does your balance sheet sort of allow it? And in this case, I should say, in the last 3 to 4 years, things have been pretty nice. So before that, the reason I say that is, about 8 years to 2020, we had the twin balance sheet crisis. We had banks that had NPAs on their balance sheets, and we had corporates that were over leveraged. So over 5 years, balance sheets look much better today, and there is room for private corporate capex to pick up. And when will it pick up? How will it pick up? We're seeing signs already, as you rightly mentioned. Some of the areas are seeing good amount of private capex. But my last comment there would be the composition of capex that you saw then, say 10 years back, and today is also different. So you're not seeing, you don't really need probably huge amounts of steel today. You don't need that kind of cement, cement beyond the construction aspect. So where you probably will see spending is areas like aviation, areas like technology.
Yeah.
Let's not forget just a case in point, 2 of the largest aviation orders ever given are from Indian airline, companies that are operating out of India. So from the current 85, 90 wide body planes that we have today, I was just talking to someone yesterday, we need about 500 of them. So significant amount of capex is coming up in sectors that are not your traditional sectors.
No, absolutely. So what do you think? We have elections coming up, and the new government will have challenges in boosting consumption, boosting capex, because the burden of capex, as we all know, for the past few years has been unfortunately solely on the shoulders of the government. But what do you see as the major challenges for the new government going forward?
So as you articulated well, one is how do you lead to a higher consumption. So the thought process, as we understand, is I think there is a very clear sense of moving away from entitlement to empowerment. You don't want to you want to create conditions for better growth to happen. You want to create conditions for better capex to happen, but not necessarily dole that capital out. A very clear case in point is how India handled the pandemic versus very many other countries. So you had fiscal impulses by several countries. You had monetary stimuli by many countries. India, the idea was that, but more importantly, much more targeted. So first of all, India's fiscal balance sheet wasn't that good. We had a fiscal deficit even going into the pandemic.
Yeah.
But the idea was targeted credit, and that seems to have worked out rather well. Our fiscal numbers are quite decent, barring the high debt GDP ratio that we have today. And capex, governments, uh, look at it. I mean, 45 lakh crores, 45 trillion rupees of the budget, of which about 20 is overall capex. So, no, sorry, about 13-14 is about overall capex, 13-14 trillion. So the composition of the government's spending has clearly changed in the last, several years. Capex as a percentage of GDP is going up. And these are leading to better and better conditions for private capex to sort of come up.
Yeah.
And I must say one other thing here. See, the government is also sort of creating a welfare, I will not say a welfare state, but a welfare umbrella. So while you have my earlier points of the government creating investment or the government spending, the government also provides the world's largest food program. So the idea is you have to have a sort of a fail-safe. You cannot have a developed nation, as our CEO says, without consumer protection in this form. People should have access to the basics of life.
Yeah.
And beyond that, India needs to focus on education. So for me, the biggest problem India will have in the next decade or so is skilling its massive population, and education will be the key there. That's
Absolutely. I think thank you so much so far. I'd like to open it up for questions. So, gentlemen and ladies, can you please either raise your hand or put it on the chat, and I'm happy to ask your question. We have one that's already come in, and the question is, with China's PMI coming in at 51.1 and some other indicators of a revival in the Chinese economy, how do you think this will impact global inflation? And I guess a follow-on to that from my side is that the Fed has announced 3 rate cuts. At what point do you think the RBI will follow? But again, first the view on global inflation, and then your view on the RBI.
So, one of the things that was a big worry for the global economy was the slow growth in China. President Xi's unwillingness to commit stimulus, over months led to the Chinese economy sort of slowing down meaningfully. 5% growth is what they are expecting this time. But lately, things seem to have changed. So clearly, a revival in Chinese expenditure would be good news from our perspective. The big worry for many Indian markets or countries like India was Chinese dumping. So large production of China, basically coming out to the world without Chinese consumption. Hopefully there's a hurdle from that perspective. So this is, to me, very positive news. But to your bigger point on RBI, see, the thought process is the central bank has been seeing inflation in the 4 plus or minus 2% bracket. Right now we are around 5%. The RBI is at pains to point out that 4 plus or minus 2% is the band, but where they would like inflation is 4%. Yeah. Now, that would mean that you would want the central bank to sort of keep rates at this point. But there is also another, added to that is the central bank's thought process that they would want the monetary transmission to continue, to flow through entirely. The last rate hike we saw was in May 2022. Since then, the RBI has had a studied pause. There have been studies which say that about 80 to 85% of the monetary transmission has already gone through to our rates in the economy. So be they savings rates, be they credit rates, and so forth. The thought process with me is once the Fed starts cutting, the rooms for the RBI to pause or the rooms for the RBI to not cut will steadily narrow. So the sense there is that once the Fed starts, then it will open up for several central banks to start cutting.
Yeah. No, absolutely. The other question I think that's come in, it's very generic. It's come on my mobile phone. The WhatsApp is they want to know your views on GDP growth, inflation. I think you partly discussed, but more importantly on fiscal deficit, given the fact that as we discussed a little earlier, that the burden of capex is still pretty much on the shoulders of the government.
So, what you see in the last at least 4 to 5 years is a very, very conservative fiscal stance. And
Yeah.
I'm saying this with, with some numbers. Our fiscal deficit, even during the pandemic, went up to about 9%. And since then, it's been only going down.
Yeah.
Against expectations, fiscal deficit this year was lower, so about 5.8% versus 5.9. For the next year, the thought process is in a pre-election year, the government came up with 5.1%. So that shows the kind of fiscal stance that the government has. And the year after, they're looking at 4.5%. So that gives you a very clear understanding of what the government wants to do in terms of a fiscal stance. That said, there are evident worries about if the government is conservative, what happens to the only agent in the economy that's doing the spending?
Yeah.
Which is what brings me to the earlier comment I made, that the composition of investment has steadily shifted from revenue expenditure to capex. So the quality of expenditure that we've seen in the last few years has been much better than expected, and it is this, in my understanding, that's going to do the heavy lifting on capex and continue to do the heavy lifting on capex. On the fisc, my big worry remains the high debt GDP. It went up to about 90%. It is clearly in the 80s today. India has shown, earlier, in the 90s actually, how high debt GDP numbers can come down. So, but that is something that's expected. For instance, at the moment, there is no roadmap of how to reach the 45 to 50% of GDP number that is the long-term idea for the FRBM. There's no roadmap from the government. On the fisc, however, things are quite okay.
Yep. We have a question from Nicholas. Nicholas, let me unmute you.
Yeah, hi.
Go ahead.
Hi.
Well, thanks for the opportunity here. Do you think the recent halving of contract size for index derivatives will enhance retail participation and add more speculative activity and volatility to the market?
Oh, the drop in contract size, you mean?
Yes.
Yeah, okay. So, there is about policy. The one thing that you want to see about policy is that it should be predictable. The one thing that you don't want to see about policy is its unpredictability. So in India, by laws, the lot size has to be between 500,000 and 1 million rupees. That's the idea. And, lot size for any index, be it, Nifty, Bank Nifty or anything, any stock, is always decided from this perspective that it has to be between 5 and 10 million rupees. Now with Nifty at 22,000, a lot size of 50 would take it definitely, north of 1 million rupees. It was around 1.1 million or so forth, and which is why the lot size has sort of come down. This is just rules. It is not a decision in any other sense. It's just logical that the lot size has been reduced. Now let me look at the implications. So the implications are have to be seen in this manner. In my presentation, I've shown how retail investment has been growing up, and rising significantly in the Indian markets over the last 5 years. So, and the causes did not involve any of these kind of policies that, it's cheaper for the people to sort of get in. That said, you have to look at these things. India's per capita incomes are south of 3,000 US today. So the lot size, the contract size that that you have in a typical derivative transaction is meaningfully lower than many other countries in the world. So US, for instance, at 5,000 on the S&P, your notional value will be 500,000 dollars. For India, that number would be something like 13,000 US dollars. 13. In China, the number will be around 45,000 US dollars. So the lot size and the contract size are a function of the per capita income. But in terms of speculative activity, one must understand that a lot of trading today happens towards the expiry, and which is where options, especially deep OTM options, go close to zero, and thereby giving a huge amount of leverage, automatic implied leverage. That's not going to change if you have lower lot sizes. I mean, anything that goes to zero will go closer to zero.
Okay, thank you very much.
Thank you.
Okay, we've got two more questions. Takeaways. Any sort of takeaways from a recent RBI diktat on currency derivatives trading? Is it a big risk to NSE's revenues?
So first of all, in terms of the revenue breakup for the exchange, the largest, by far the largest share of NSE's trading revenues come from transaction charges. This is, say, in contrast to London Stock Exchange, for instance, where data also has a significant share. For India, transactions for NSE transactions are important, but the vast chunk of those transactions are on index options, not on currency derivatives. Currency derivatives is fairly small, very small, in fact. And I will not comment about what will happen to NSE's revenues, because that's not, I can't comment on that. But I'm just telling you that the share of index options is vastly larger than any other product that we trade.
Understood. And then we have a question that's just come in. Sorry, I'm just opening it. Okay, can you give us some color on the retail participation across different global markets, if you have that data, that is, and what gives you confidence that retail investors' share will be sticky? That's a very good question, because you've seen a lot of these guys are new to the market, first timers, and I just wish them well, but I hope they don't end up having a bad experience.
So, on the second part of your question, Gautam, yeah, India has not had a bear market in several years. So out of the last 8 or 9 years, we've generally seen only positive market. Yeah. So in market, the most important part is experience. And until you've seen a bear market, experience isn't really complete. So yeah, that's something to be said. But what exactly is our share of household penetration in the market? So for the US, that number will be around half, 50%. For China, the number will be maybe around 19 to 20%. So for India, the percentage of households that has some exposure to the markets, we have extrapolated that number, and we kind of reach 19 or 20% today. And this only when you assume that PAN is at 1 per household. So clearly the headroom for Indian households to allocate both in terms of penetration of households and penetration of their total savings is considerable. Will investors be sticky? I mean, that's a hard call. I'm just saying, as I said earlier, a bear market is basically a very good test.
Oh, I totally agree, because I think a lot of investors have been driven by, as you said yourself, mobile penetration, smartphone penetration, 4G, which was launched by Reliance Jio, eKYC. A lot of factors came together almost magically, and that's really causing the penetration in the equity markets. We have time for one more question. If anybody out there would like to ask, please raise your hand or put it on the chat, please. I think we don't have any more questions. I think you've been you explained it so well that everybody's questions have been mostly answered. So, Tirthankar, thank you again very much from Nepean Capital and all of our investors. We hope to do this again very soon with you, and wishing you and the NSE all the very best.
Thank you, sir. It's always a pleasure. Thank you. Take care.